Okay, this time we're going to look at the determination of long-run equilibrium in perfect competition. In the short run, the number of firms in the industry was fixed. But now as we go to the long run, we know that capital becomes variable, so all inputs are variable. And because capital is variable, the number of firms in the industry becomes variable. Now, we could actually look at the firms, we could look at this diagram and think about the change that the individual firm could be doing as they go from the short run to the long run. In the short run, the firm has a plant of a given size, capital of a given, or capital stock of a given size. As you go from the short run to the long run, the firm could optimize their plant size. Whatever amount of output they thought they were going to be producing, they could make sure they have the factory that would be optimized to produce that amount of output. Well, then we have to draw separate short run and long run cost curves in here and make this diagram much messier. So I don't think there's that much to be gained from that. So if you can see here, I just dropped the short run or long run distinction here. We'll just consider this to be the average cost curve of the firm and the marginal cost curve of the firm. And we simply aren't going to worry about the difference between the firm adjusting their plant size as we go from the short run to the long run. Because what's far more important is the adjustment in the number of firms. The adjustment in the number of firms is going to be the real equilibrating mechanism as we go from the short run to the long run. Okay, so we have the firm and the industry diagram. We have the market demand curve over here, and here's the firm's cost curves. Short run equilibrium, we looked on the industry diagram. In the long run equilibrium, we're going to find the long run equilibrium. We're going to find the long run equilibrium price from the firm's diagram. And the reason we can do that is because of the long run equilibrium condition in perfect competition is going to be a zero economic profit. Firms are going to have to make a zero economic profit because there were no barriers to entry or exit. On the short run equilibrium video, I showed a situation where firms were making a profit. If they were making a profit in the short run, then in the long run, the number of firms in the industry is going to increase. Why is that? Well, because remember, economic profit is you can make an economic profit when you're making above average profits. So if you think about across the entire economy, if everybody was making an average profit, we'd call that zero economic profit. Any economic profits are positive economic profits are an above average profit. So one way of thinking about this is that any industry where you have economic profits is like a really good party. And what do people want to do when there's a really good party? Well, they want to go crash that party. So if you've got a really good party going on, more firms will want to come crash that party. And so when they're in a short run equilibrium, if firms are making economic profits, we'll have entry of new firms into that industry because from an investor standpoint, this is an industry where you can get really good returns. So that's where you want to try to put your capital. And we'll assume that what you need to do is create new firms. So new firms will start up. There are new firms in an industry where they're making economic profits. People want to start new firms will find it very easy to go to investors and raise money because you can point to the existing firms in this industry and they're making these really high rates of return on investment. Investors want to crash that party. They'd be willing to fund a whole bunch of new upstart entering companies. If firms are making an economic loss, which might be an accounting profit, but they're making an economic loss, meaning they're making a below average return on investors' money, then that's a bad party. And if you're at a really lame party, you want to leave. You want to go find something else. A better use of your time than to stick around at a lame party. So if the firms were making economic profits, investors would want to pull their money out. Well, as investors pull their money out, well, for some of the firms in that industry, that would mean that they would be losing their funding and they would end up going out of business. So as we go from the short run to the long run, if firms are making losses in this industry, some firms will disappear. We won't worry about which ones specifically. But if you had like 200 firms in an industry and are making losses, we might see 10 of them or 20 of them or 50 of them go out of business. As long as they're still making economic losses, investors will still be heading for the exits and will be trying to get out of that industry. So this means that what we have is that the long run equilibrium condition is zero economic profit. And this is sometimes also referred to, some authors will refer to this as the elimination principle. In the absence of barriers to entry or exit, profits will be eliminated by investors either jumping in or exiting an industry based on whether that the firms in that industry are making profits or losses. So in the long run, economic profit has to be zero. We won't see the number of firms in this industry stabilize until we get to a situation where economic profits are zero. So that tells us what the equilibrium price has to be. The equilibrium price has to be, because remember, profit per unit is price minus average cost times quantity. So for a zero economic profit, you have to have price equal to average cost. The firm's also going to have to be maximizing profit. They're going to maximize profit where marginal revenue is equal to marginal cost. So we know that price has to equal average cost, and then we also know that marginal revenue has to equal marginal cost to maximize profit. And we know that marginal revenue, remember, in perfect competition, because we're going to draw that horizontal firm demand curve, marginal revenue is equal to price. So this means that since marginal cost has to equal to price and price has to equal average cost, we also know that average cost has to equal marginal cost. Average cost is equal to marginal cost at one and only one point on this diagram with these cost curves. And that's why I said we are going to find the long run equilibrium here on the firm diagram. We know from what we just said here in terms of our long run equilibrium condition, we know that the long run equilibrium has to be here, where the marginal cost curve intersects the average cost curve. This is going to have to be the price. If we project this over here, that's going to have to be the long run equilibrium price, and then this is going to be the quantity that the typical firm will produce. So we know that this has to be the price. So we could draw in a horizontal demand curve for this firm, or horizontal demand curve for this firm, which is also its marginal revenue. And then we know we have to have this price over here determined come out in the industry. So we just take this price from the firm diagram over to the industry diagram, because we can do that. We can go horizontally but from one diagram to the other. And then that note lets us know over here, now, at this price, consumers in the market demand is telling us consumers want to buy QLR units of this good. So at this price, the market demand curve tells us how much consumers want to buy in the aggregate. Each firm, if you want to think of all of these firms as completely identical, each firm is going to produce this amount. In the aggregate, we have to have this amount produced. How many firms do we need to have? Well, we would need to have this number here divided by this number here, and that's going to tell us how many firms. So in effect, if you think of what I said before, like firms are, if you're making profits, firms are entering the industry. If the firms are making losses, firms are exiting the industry. This is the magic number of firms. With this cost curve, each firm is going to be operating here, and then we adjust the number of firms to get to the quantity over here that we're going to need. Now this would suggest us what we do is like, oh, whatever this number is, we would simply be adding up we would do this horizontal summation of the individual firm's supply curve, and then that would give us an industry supply curve. But that's not quite the way to think of the supply curve in the industry in the long run. But I will draw that in here. So you sort of think of this as like, I drew that in there for this right number of firms. This would be the summation of the marginal cost curves for that right number of firms. But if you think about it, we're adjusting the number of firms in the industry, and we can do that in the long run. So this in effect cannot be a long run supply curve for this industry, because this is for a fixed number of firms, and even though this is the number of firms we will have in long run equilibrium, the number of firms isn't fixed at that number. It could vary. So it actually makes sense that what we should do is draw the long run average supply curve to be horizontal. And so that's what we have here. And then that's actually the better way, because as the number of firms varies here, we know that each firm is going to be producing at this level here, and they will be able to make a zero profit at PLR. So we could actually adjust the number of firms in this industry to have more or less supply, and each of them would be happy to be in this industry making a zero profit at this level here. So this is really the better way to think about drawing in this long run supply curve for the industry. And so there we have it. That's a long run equilibrium in perfect competition. We can really locate, we can get the long run equilibrium here off the firm's diagram. The zero profit condition is telling us the price has to be at the bottom of this U. So that's going to fix the long run equilibrium. That's what's anchoring everything here. And then from there, we can figure out how many firms we need to have in the industry so that we can produce the amount that consumers are going to want to have supply. So there we are. That's long run equilibrium in perfect competition.